When it comes to investment in the stock markets, one of the most important factor one should avoid is emotional interference. As much as possible, we rely on logic, rely on reason. We invest based on appropriate laid down principles, and as much as possible, we should not allow emotions to govern our decision making process. And so, emotional resilience in stock investing is essential for navigating the ups and downs of the financial markets, where emotion can easily lead to impulsive decisions that harm long-term investment goals. So, as much as possible, you need to do away with emotions. Don't allow emotions to interfere with your decision making process. Be rational, be logical, invest based on proven principles. Don't allow fear, don't allow greed, don't allow, you know, any kind of emotions to interfere with your process as an investor. And so here are key factors to consider. We're going to consider in the course of this video. That's how to build and maintain emotional emotional resilience. How to stay calm. How to remain cool, unperturbed, undisturbed, unruffled by the noise around you, by macroeconomic activities around you, and by the fluctuations that are bound to take place in the markets. And so you need to maintain that level of emotional resilience. Number one here is understanding market volatility. For you to be able to do away with emotions, you need to first of all understand market volatility. The stock market is inherently volatile. The stock market doesn't go, it doesn't go up in a straight line. No, it goes up and down like a zigzag, like that. That's how stock market moves. And not only that, and the price swings, the normal price swings are part of the investment experience. The fluctuation, the price swings are what really constitute the natural behavior of stocks in the markets. And so emotional resilience starts with recognizing that market fluctuations are normal, and it's something you must learn to live with. It's normal, and they don't necessarily, reflect any fundamental flaw or any other flaw or error or whatever in the market. It's just a normal, natural rhythm of the market. It doesn't really, indicate any kind of flaw. No, it's natural. It's part and parcel of the market. The market will always fluctuate, and that's just the way stocks behave. And so understanding market cycles can help investors stay calm during downturns and avoid emotional reactions like panic selling or overexposure to risk during bullish phases. Usually the market is always up and down. Sometimes it will become bearish, sometimes it becomes bullish. But whatever is the case, we are expected to remain calm. When the market is bullish, we don't just put our entire money at risk. And when the market is bearish, we still need to apply some strategies to avoid, sustaining huge losses. It all depends on, our emotional, resilience. Number two is setting clear, goals and a strategy. Setting a clear-cut goals and having a proven strategy. And so one of the most effective way to build emotional resilience is to set a clear investment goal and a well-defined strategy. Knowing exactly why you are investing, whether for retirement, whether you want to build a house, or you want to fund your children's education, this actually can keep you focused when market movement triggers, our emotional response. So because of your aims and objectives. So whenever there's that particular fluctuation, that volatility in the market, you remain calm because as far as you're concerned, you are simply a long-term investor with a goal in mind, and you will not allow all those noise in the market to kind of interfere with your decisions as an investor. And so you remain calm, you remain focused because of the goal you have you have you know you have in mind. Additionally, sticking to a diversified investment plan can help minimize the emotional impact of any single market events. You must have your goal is clear cut. You must have your objective. All right. And so, with all these things in mind, then of course, you will not be easily carried away. You will not allow, noise in the market to disturb you. The other one is managing fear and greed. Managing fear and greed. And so, fear of loss and greed for high returns are two emotions that can lead investors astray. Fear of losses and greed of outside gains are very powerful emotions that can distract you from your goal in the market. So fear often leads to selling during downturn or avoiding investments altogether, while greed can encourage reckless decision making during market booms. You want to put in your entire fund into the market because of the expected outsized returns. So developing a disciplined approach to investing with a focus on long-term goals rather than short-term fluctuations help reduce the emotional impact of fear and greed. And so your goal and objective will help you to do what? To overcome these devastating emotions of fear and greed. The other factor there is developing patience. Number 4, developing patience. So emotional resilience requires patience. Investors often need to be willing to endure short-term volatility in exchange for long-term gains. In the short term, the market will always remain volatile. We always, be in a volatile state. But in the long run, you will always do what? You will always obtain your long-term objective. And so the ability to ride out downturns without reacting emotionally is a hallmark of a successful investor. For you to become resilient during economic downturn, when the market is in a recession, whenever there's market correction, remain calm. That is a very good attribute of a successful investor. And not only that, study shows that patient investors who remain calm in the face of market turbulence tend to perform better over time than those who make frequent emotion-driven changes to their portfolio. People who are governed by emotions discover that you don't really perform as well as those people that have a level of discipline and patience, as an inherent attribute, of their being investors. And number 5 here is mindfulness and stress management. Mindfulness and stress management. In this context, emotional resilience can be enhanced through mindfulness techniques, which help investors stay focused on their long-term goals rather than short-term distraction. Once you are mindful, once you are calm, once you are coordinated, once you are meditative, then of course, the short-term fluctuations and noise will not disturb you an inch. So stress management strategies such as meditation or deep breathing exercise, can help investors detach from daily market fluctuations and avoid, making impulsive decisions based on temporary emotional states. Then the last one, number 6, is overtrading. Overtrading due to emotional impulse, because of because of your emotional state, you want to sell when it is not necessary, based on fear or excitement. This can harm your returns. And not only that, it often leads to missed opportunity or buying at the peak, and you end up selling at the bottom or at the trough. So staying patient, review your investment, plan regularly, and avoiding the temptation to react to every market move will help, to foster resilience, and at the end of the day will contribute to the quality of the returns you are going to make in the markets. And so, in a nutshell, we should try to develop emotional resilience. Never allow your emotions to interfere with your investment process. Although it's easier said than done, because we human beings, we are emotional beings. But if we harness the discipline it takes to, remove emotion from my investing, I'm telling you that if you give us a better result, an outstanding returns at the end of the day. Let's learn to remain calm. Let's learn to remain, kind of detached from the emotional state of the market. And by so doing, that will help us to be able to keep our focus intact and invest based on our principle, based on the overall goals and objectives we've set for ourselves.